Good afternoon. Welcome to the TheoTRADE afternoon video. I'm Blake Young. Today is August 22nd, 2024, and we're going to talk about there's risk to both sides of this market. And we're looking at this from a technical view. I'm going to get into the discussion of what Jerome Powell is saying in Jackson Hole tomorrow morning with Brandon in TheoTRADE Live. So join us there for sure tomorrow morning. But as we're looking at this, I'm going to focus on the technicals and again the sectors that we should be paying attention to, probably the closest. And number one, with the S&P 500, the SPX in particular, we've created a widening candle. You can see this higher high, lower low. This higher high and lower low has taken out the last 2 days, and it could maybe by the end of the day even clear out this last low and reset the entire week. So we can make a new high and a new low for the week all in one day. Now that's because we have the Jackson Hole Summit going on and Jerome Powell is talking. And as Jerome Powell talks, the market is trying to price in rate cuts. How many, when, and speculating on the future. When we're looking at these moves, we can see that there has been a shift in the expectations, a shift in probabilities. We at one point this last year, we were looking at nearly 4 cuts, maybe even 5 by December. Now we're seeing that tone down, but we're still talking about rate cuts. The question is it going to be enough? Is it going to not be enough? And reality is this is not just a widening pattern for today. It's a widening pattern since August. So we created this massive reversal, lower highs, lower lows, and then we created a huge run up. And from the weekly perspective, we've widened as well. So the risk to the upside is minimally this candle. Today's range about 80 points in the S&P 500. So we are looking for maybe another 1% above today's highs, which would be record highs, or 1% below the lows, which would be looking at an additional drop of about, call it 80 points below the low, and therefore we'd be looking at getting all the way back down into here and trading in, filling in the gap. Now that's pure technical on the short term. On the long term, this move, this reversal off the high, creating a peak and a trough, we've got about 5,100 to 5,600. We're talking about 10% of the market. That to me is the real risk that we're pricing in. If we break through the high, could we run up another 8 or 9%? Is a rate cut going to stimulate the market to run 8 to 10% higher? I'm not sure. But the 10% on the way down is not just to retest the lows, it's 10% below the lows, which would tell us that we may be facing a 15 to 20% correction. And again, we'll get into the fundamentals and a little bit more detail tomorrow morning. My view is, as we're looking at the data going into this, trying to avoid the real focus on the Fed, but kind of the data that's feeding the Fed, what are we seeing? And I talked about this over the last couple of weeks, that we really are creating what I consider an uptrend in weekly unemployment filings. We talked a little bit about the revisions that had been reported this last week, that we're nearly 1 million jobs less than we thought we were, and the uptrend, the cumulative increase of weekly new unemployment filings has continued this uptrend really since the beginning of the year. Week over week, we made higher highs, higher lows, higher highs, higher lows, and the bounce up this week is really facing the continuation of higher, and we could be looking at 250, 280, 300,000 job losses. We could be looking at weekly new unemployment claims at the highest level it's been in years. And we're certainly in that progression. We're certainly seeing higher highs, higher lows. So the Fed is looking at this and saying, if the market is slowing down, if we're seeing economics show us that we need to stimulate the economy, how do we cut rates so that unemployment doesn't stay above that 4.5, 5%, 6% maybe over the next few weeks, especially where we already show that we needed to unwind nearly 1 million jobs. And so this higher high, higher low in today's bounce up is absolutely an indication to me that we need to be cautious in assuming that the economy is doing well, that the consumer is doing well, and we're seeing this showing that we are absolutely in a trend of a worsening employment situation. Now, if I put the revisions in, you can see many of these revisions were equal or a little bit higher. So higher weekly unemployment claims, lower total number of employed, lower total number of new jobs net, and this is not a good scenario. And even though the U.S. does not depend on manufacturing nearly as much as it once did, if we look at this number, any number below 50 is market contraction. And if we look at the trends here in manufacturing, We had a huge spike 2021, 2022, but really we have barely stayed above that 0 line, or in this case, the 50 line. It's showing contraction in manufacturing nearly every month. In fact, we only have about 5 months going all the way back to October 2022 that were not negative or contraction of manufacturing. And so this is not good. It's actually one of the worst numbers we've had going back. Well, it actually does go back a full year. And so the worst number we had in manufacturing, Flash Manufacturing Purchasing Managers Index, goes back to the lowest level we've had since last year. So there's another strike against the economy. So here we are facing new economic slowdowns, unemployment rising, weekly unemployment claims going up faster in an uptrend. Existing home sales, well, this is where we oftentimes see the economy show some stability, as this is where consumers get their largest asset, their largest really access to cash if they need to refinance. And this was a better than expected number. We bumped up from 0.4 to 0.5. And that might be good enough to think that things are good. But as we look at this, the trend is absolutely down. We had 1 week, that's all that happened, or one report that bumped up just a little bit, but it's still in a downtrend. Lower highs, lower lows, lower highs, lower lows. And so this one bump up, it's not going to take very much for it to go down. It's not going to take very much for it to go back down and retest the previous lowest level right here at 2024. And so you can see what this looked like in 2008, 2009. We had a downtrend of existing home sales after the housing market crashed. And you can see the low point we got was December of 2008, and we had a 4.49, revised down to 4.45, but we'll call it 4.49 in 2008 during the housing crisis. Now we did get lower, and the lowest point we've been at on the chart is 3.83. So when we're talking about this, this is the second lowest report we've seen in years, including the crisis. So we had that little low here, just a little bit lower than this one. So the second lowest trough, including the housing crisis. So I don't see that as good. I don't see that as a real sign of recovery, a 1 month bounce. We're near the lowest levels we've seen, including the time after the housing crisis. This does not seem like a healthy economy. And before we go in to discuss the top sector, bottom sector, and maybe some stocks to look at in conjunction with that, let's go to the ZQ one more time. For those of you that were not with me during the live session today in the main room, what I like to do is I like to take this last traded price, knowing that we have a Fed meeting to decide things in September. And if we look at this right now, we take 100, we subtract off this 94,795, and we get 5.205. Now, where are we at currently? 5.375. So even as we're looking at this, yes, the market's saying we could have 2 rate cuts in September. The futures traders are not pricing that in. The futures traders are pricing in 0.17. 0.17 of 0.25, which means we're not pricing in 2 rate cuts. We're only pricing in approximately 64% probability of 1 rate cut. And that's after all of today's played out, that big sell-off and the behavior and comments from the Fed, at least according to the Fed funds futures. That's not 2, and it certainly isn't 3 that we were pricing just a couple of weeks ago. If we're to look at December, we can do the same thing with December's numbers. Subtract 95.44. We reached a peak where we were pricing in 5 rate cuts, 525 basis point rate cuts for December. As it sits right now, we're at 4.56, a little bit different than what we were earlier in the day. But if we're comparing that to 5.375, then what we're expecting, 5.375 minus 4.56 gives us 0.815. So if we take the 0.815 here, that means that we have 3 25 basis point cuts, which equals 75 of that, and it leaves us with 0.065. So that says we have 3 rate cuts, not 5, and we have about 26% chance of a 4th. That's what's being priced in today. Not nearly the cuts that we had thought. And we'll get into, again, more details tomorrow as what this is really telling us, going to 1 versus 2, going to 3 versus 5, and what we're really seeing and what could happen with the Fed going into their September meeting. But in the end, all I care about is where should I be parking money? Where should I be moving money around? And the worst performing sector today, down 2.5%, is technology, followed by consumer discretionary. That is no surprise to me. When we're seeing this move, this rally, this huge recovery, we recovered off of hope. We did not recover off of any real shift or change in fundamentals, financials, reports, earnings, or anything else. There's no data that was supporting that rally. And so I'm still looking at favoring shorting technology and going long healthcare and utilities. As you can see, technology has fallen all the way down and is about to do what I commented on the S&P, that we are going to make a higher high and a lower low for the week all today. We're going to clear out Monday's candle. We're going to clear out that low. The low of technology on Monday was 219.98, and we're at 219.99. So 1 penny away, and we still have 24 minutes to go. That is a huge engulfing candle, a huge warning that this is a reversal and likely to send it back down at least halfway, if not all the way down to the previous lows. Technology looks really rough. Now, part of the reason why we look for technology is we've seen NVIDIA climb up and do the exact same thing over here. Huge ranges, huge swings, but my biggest view on this one is that we shouldn't be worried about trying to trade NVIDIA. We should trade those that are dependent on NVIDIA's growth to continue to climb. Taiwan Semiconductor rolled over 2 days ago. Taiwan Semiconductor expanded today as well, but we've not just wiped out 1 week, we've gone all the way back to the previous week. So if we're going back to the previous week, almost taking out its low, we're wiping out 2 weeks of growth, and TSM looks very bearish all the way down to 144, maybe to 135. And I know the professor highlighted that in his session today as well. But in the same realm, if you look at things like AMD, AMD is engulfed here. The next target for me on the way down could be 130, and the premiums are good for selling calls and buying out of the money puts to try to trade it back down to 130. There could be a 20-point move. You were talking about 17 to 20% decline in AMD. I also like Micron for that same kind of idea. We've traded up to the high, retested. There's a strong barrier right here that we've been kind of trading flat at, clearing everything out. Traded a new high, a new low, and I'm looking at Micron to drop down to 88, maybe to 86, which means we're looking for nearly a 20% drop in Micron as well. Now, I would normally look for healthcare and consumer staples up here. They're pushing to new record highs, but again, we create a widening candle. It makes it a little bit more questioning to me as far as whether that's the place to go, which is why I'm looking for XLU as both a defensive sector and a substitute for bonds. If the Fed cuts rate, utilities are likely to continue to grow as a correlated instrument with bonds or notes, and utilities didn't create a widening pattern today, retested the breakout, and is still holding up. But I would look specifically at individual utilities inside here. And though normally I'd jump over to Nextera and try to take a bullish trade on Nextera, it is back below its previous highs. It did create a lower low today. So I'd wait for Nextera to give me a bounce. Duke is going to be similar. You can see there's a lower low there. Dominion as well. It's holding up. It's okay. And it looks a little more closely related to utilities, XLU in general. Southern, as you can see, has created a lower low as well. So I'm looking now, instead of the traditional ones I like a lot, I'm looking at AEP. And AEP seems to be bouncing. The gap down, close up is being resilient. And the upside for AEP could go all the way back to 104. So while we're benefiting from 10 to 15% declines in technology, we could be benefiting as well from a 5% or more growth in AEP. We have a couple of others that have done well, like multi-utilities, such as WEC. And you can see breaking out to new 52-week highs. This would be very much like a Gianni type of play. A 52-week high on a breakout on WEC Energy, which is evidently is Wisconsin Energy. So there you go. Two others. One gave us a little bit of grief in our deep currents class, but we created a widening pattern, came back, consolidated, and just like we saw the consolidation and breakdown, Vistra consolidated, broke out yesterday, and has followed through, clearing out these highs. So now I'm looking for a minimum to refill the gap, which is not far away, about 85.93, so we'll call it 86. And we're looking for maybe a $3 move up, but the next major barrier is all the way up here at 92. So we could be looking at a 12 to 15% increase in Vistra. And CNP is interesting to me from the way it's rounded out. It's called a rounded bottom, and we broke through the high today. It is deeply discounted from its previous high. I'm not necessarily saying it's going to go all the way back up to the previous high, but I do like the bullishness, the strength that is behind center point, and the clear of the short-term high, as it should be able to get up into the 28, maybe 29.50, and we're looking at a 10% move up in CNP as well. Well, that's going to do it for me today. I would encourage you again to join us tomorrow as we get into more of the nitty-gritty of what's going on with Jackson Hole and what it really means if they only cut 1 or 2 or 3. Can I get 4 by the end of the year? I don't think so. I think we're going to see some shift in policy and sentiment, but we'll get some more guidance tonight and tomorrow. We'll talk to you again in the morning.